Right now, the ground is slipping away from under the feet of global markets. After 40 years, Japan is stopping its sponsorship of America's debt addiction. The yen is in free fall, Wall Street is on edge, the bond market is flashing red signals, and mortgage rates in America are creeping up. And all this because of decisions made 1,000 kilometers from Washington in the city of Tokyo. For many years, I've followed media giants, and I've seen how editors mold news into convenient fairy tales for the crowd. I'm tired of their hypocrisy, so on this channel I work only for you. I tell everything as I see it, without filters or distortions. If you appreciate this approach, give a like and listen carefully to the end, because what comes next is something most analysts have simply slept through. Let's break down what's really happening in Japan, because this isn't just another news from foreign markets, this is a crack in the foundation on which all American borrowing rests. And considering that the US is the world's largest economy, this is important for other countries too. Recently, Tokyo authorities rolled out a gigantic economic aid package. And what did the news tell us? That it's just support for economic growth and stability, that everything is under control. But in reality, analysts warn that this aid package could destabilize not only the Japanese financial system, but also the American one and then the global one. The market's reaction was immediate and brutal. The Japanese yen collapsed to levels we haven't seen in a year. Think about it. The currency of the world's third largest economy isn't just depreciating, it's losing value at a frightening speed. And Tokyo officials are no longer just nervous, they're literally hysterical and threatening. Finance Minister Katayama tried to scare the market, stating that the ministry is ready to intervene harshly and punish speculators. The market, of course, turned upward on these words, but let's be honest, this was just a death throw. Words can't put out the fire fundamentally, because nothing has changed. The yen is flying into the abyss, and traders already smell blood. But Japan's problems no longer stay in Japan. Today it's a global bomb with a timer. Economists like Peter Schiff warned directly, Japan could accidentally torpedo the US economy. Is he exaggerating? Since the new Prime Minister Ishiba took office, the yen has fallen 6%. For cryptocurrency or even stocks, 6% is nothing. But for a currency tied to the world's third economy, this isn't just volatility, it's a distress signal. Why is the yen falling? Because they're pouring gasoline on the fire. Japan is injecting money into the economy, but at the same time, the Bank of Japan continues to maintain an ultra-soft policy. In simple terms, they're racking up debt and printing money, but refusing to raise rates to cool inflation. Does this remind you of anything? It's like Erdogan's economic experiment in Turkey. He also thought he could ignore the laws of economics, and we see the results. The lira flew into the abyss. Tokyo is now following the same tracks. The market sees this imbalance and reacts the only possible way by selling off the yen. And here's where the most interesting part begins. Something is happening that shouldn't in a normal economy. Japanese government bonds and the yen itself are falling simultaneously. This is a signal that investors are losing faith in everything. Usually when the currency weakens, people flee to reliable government bonds. But when both are falling, it's no longer trading. It's capital evacuation and loss of trust. Investors aren't just nervous, they're literally fleeing. Analysts are already drawing parallels with the collapse of Britain's debt market in 2022. Remember what happened then? If you've forgotten, let me remind you. This is a perfect example of how quickly everything can collapse. The Liz Truss government decided to play the good wizard. They announced huge tax breaks. On paper, the plan was beautiful. We'll cut taxes and the economy will bloom. But there was a nuance. They forgot to say where they'd get the money for it. Investors calculated the numbers and said, "You guys are bankrupt." And they started panicking and dumping British government bonds. Think about it. The country's pension funds were on the brink of complete disappearance in just 48 hours. The central bank had to urgently turn on the printing press and buy up these debts just to save the country from collapse, and the Truss government resigned. So unsecured tax breaks collapsed the UK bond market and nearly buried the country's pension system. And now, look at Japan. The scenario is 1-to-1. Tokyo announces gigantic stimuli to rev up the economy. But they already have 235% debt to GDP. They owe twice as much as their entire country produces. The market sees this and shouts, "You have no money, the king is naked!" And the same bond market collapse begins, where trust disappears instantly. But there's one scary difference. British problems are just British problems. but Japan is America's wallet. If Tokyo collapses, it will drag the American debt market down with it, because Japan is the main creditor of the US. For decades, Japan was the main sponsor of the American way of life. At its peak, it held $1.2 trillion in American debt. Essentially, Tokyo subsidized Washington's habit of spending money endlessly. It was Japanese bond buyers who kept US mortgage rates low and loans cheap. They allowed the US government to borrow trillions of dollars without much consequence. But today, the era of freebies is over. Yields on Japanese bonds have soared to 1990s levels. You'll ask, but yields in the US are still higher. Plus, investors are losing trust in Japanese bonds. What's the big deal? Well, let's pick up a calculator. Yes, in America you'll get 4 to 5%. But to buy this debt for yen and not burn on the exchange rate, you need hedge insurance. And right now, it costs insane money. In the end, investing in the US, a Japanese investor is already going negative. At home he gets his 1-2% clean, without currency risk. As you see, he's returning money back to Japan, not because he believes in its bright future, but because the math is no longer on America's side. Investors are also holding Tokyo by the throat. Want a loan? Pay more, not pennies, and the state is forced to pay. That's why yields are rising. Besides this, Japan has a problem with an aging population that prefers to keep money closer to home, and new regulatory rules in Japan are forcing local insurers to buy precisely Japanese ultra-long bonds. All these changes are ultimately directed one way away from American debt. And here's the main question that Washington is trying to ignore. And who's going to pay for the banquet of uncontrolled government spending now? For the US government debt market, Japan is the blue whale that absorbs this debt by the ton. But now this whale has started selling. In the third quarter alone, Japanese investors sold US Treasury bonds worth $62 billion. Analysts say the Japanese whale is just diversifying. But when the whale sells $62 billion, that's not diversification, it's an exit. Japan is leaving the market where it dominated for over 40 years. Wall Street is waking up from this in a cold sweat, and Citigroup has already called this scenario a market Armageddon. Charles Schwab warns that because of Japan, rates in the US will soar even higher. And guess who's already paying for all this? Ordinary people like us. Mortgages were 2.6% and today they're almost 7%. Auto loans are getting more expensive, credit card rates are hitting records. This is the direct price of Japan leaving the American debt market. This exit leads to buyers of American debt demanding ever higher yields for risks. That's why the US dollar fell this year, and bond yields still rose. The era of cheap borrowing and freebies is officially dead. And the scariest truth that the media fear to admit, this isn't a temporary correction. This isn't a couple of bad quarters that will resolve themselves. This is the new reality. Japan is aging and drowning in debt. Their public debt is 235% of GDP. In simple terms, they owe twice as much as their entire economy produces. The bond market is cracking at the seams. And now the new Prime Minister is getting into an economic war with China. There are already boycotts, bans on seafood, and military frictions are starting, especially around Taiwan. They urgently need money for defense and saving their own currency, but there's nowhere to take it from. The latest auctions for selling debt failed. Japan has driven itself into a deadly trap like zugzwang in chess. Look for yourself. Option A. They raise rates to save the yen. As a result, the cost of servicing their gigantic debt will skyrocket. The budget will burst. The country could declare bankruptcy. Option B. They leave rates low. As a result, the yen will continue flying into the abyss like the Turkish lira, burning the savings of ordinary Japanese to ashes. There's no choice. The system that seemed eternal is crumbling before our eyes. But there's option C, which, judging by everything, Japan prefers the most. Japan has been accumulating US bonds for years like a piggy bank for a rainy day. And today, that rainy day has come. The US is pressing, China is pressing, the population is aging, and they're forced to open this piggy bank. They sell US bonds, get dollars, with which they can finance both saving the yen and the conflict with China. And this is what leads to the mechanism that ties Japan's problems to US problems, and then to the problems of the whole world. Problems that echo in everyone's wallets, even Bitcoin holders, who have lost $40,000 in value lately, falling from $125,000 to $80,000. When Japan saves its currency by selling US bonds, the yen starts to rise, and this closes the global casino. For years, speculators borrowed cheap yen and bought everything with it. Nvidia stocks, Bitcoin, bonds. This is the fuel on which markets grew in recent years. But now Japan is turning off this tap. As soon as the yen rises, repaying debts becomes unprofitable, and speculators panic sell assets to pay off those debts, and first of all risky assets like Bitcoin. And we saw a rehearsal of this last year. As soon as the yen twitched a bit, the S&P 500 collapsed 3% in one day. I talked about this mechanism in more detail in a recent video. And by the way, it got almost 250,000 views. That's colossal numbers for me. And thank you for that. And what's next? What to prepare for? First, accept the new reality. The era of freebies is over. If you have floating rate loans, fix them immediately by refinancing to a fixed percentage. Even giants like BlackRock and Morgan Stanley are changing tactics. They're moving into real assets, gold, commodities, and real estate. Diversification is no longer a smart move. It's a necessity for survival. By the way, in the next videos, I'll tell what billionaires are doing right now. Well, for now, we're on the threshold of a historic shift. The 40-year scheme where America lived large and Japan paid is officially closed. Tokyo has run out of money and run out of people. Demographics don't lie, and along with them, the illusions are gone. Now the USA country with a wild deficit and political mess will have to fight for every investor dollar. And it will have to do this at the worst possible time, especially amid this adventure around Venezuela. Remember 3 things we'll now live with. First, Japan is dumping US debt not out of malice, but just to survive. Second, the bill for this comes to ordinary people. Mortgages, auto loans, credit cards. All this will get more expensive because America lost its main sponsor. And third, the global carry trade casino could explode at any moment. This is the reality that's already knocking at the door. So subscribe to the channel to see the facts, no matter how inconvenient they are. In the next video, I'll talk about Washington's response to Japanese moves. Trump already has a plan on how to attract investments to the US, and how to deal with a public debt that just exceeded $39 trillion. Watch my videos, and see you soon. Bye. Yes.